I think the big distinction that VCs are tending to make these days is between application layer AI and infrastructure. Basically, it boils down to, are you using someone else's models or are you building your own model? The people that are building their own model, they're getting money in a way that it's basically unprecedented. How much money you can raise if you are trying to compete with OpenAI and Anthropic. Whereas if you're building an application layer company, the competition is a lot fiercer. What's a problem is that bootstrapping, outside of Adam and some other folks, doesn't have any marketing for it. Whereas venture is amazing at talking about itself, and there's all these regular checkpoints. You raised a seed, you raised a Series A, profile in the Wall Street Journal. We're a big hot Series B AI company. There's just a lot of milestones that external people can track. Whereas if you're a bootstrapper, we're just running our business. And we reported a profit this year, nobody cares. And so you can either choose the side of really high expectations, a lot more attention, but potentially less terminal value, or I'm gonna build in the dark and no one's gonna care about my business and I might exit for more money. It's sort of your choice.
If you have a 1% chance of being a billionaire, you should do that. If you are good enough to create a unicorn, you probably have an 80% chance of creating something that spits several $1 million, into your own pocket every year. The smart path, in my opinion, that gives the founder the most optionality is to avoid taking institutional capital until you really want to or have to for some reason.
Welcome back to the show. Today's guest is the head of insights at Carta. Carta's mission is to make private markets as connected as public ones. He is a data storyteller. He's an expert on early stage funding, and he's here to break down the current VC climate, when you should take money, how you should spend it, and all things related. We're thrilled to be joined today by Peter Walker. Peter, welcome to the show, my friend. Thanks for joining us.
Pete, Adam, good to be here, guys. Thanks for having me.
Hey, thank you. And Adam, what are 3 things people will learn if they stick around until the end today?
Okay, you should stick around to the end of the show because number 1, we're going to tell you what to do if you want to bootstrap your startup, but you don't have any money. Number 2, we're going to tell you what to do if you experience a wave of massive traction, investors are banging your door down, specifically when you should take money, when you shouldn't, and if you do what you should do with it. And number 3, we're going to talk about why Combinator should you join, what's good and bad about it. And we're going to tell you about one way to run a tech company that absolutely nobody is talking about that makes a lot of sense to all of us. I'm excited about this episode.
Let's go.
All right, well, let's jump into it. We definitely have more we would like to cover than we have time. So to start, Peter, could you please tell the audience about Carta, what it does, who it is for, etc.?
Absolutely. Carta began life as an equity management platform, meaning we help founders manage their equity, the slices of ownership that they give to employees, that they sell to investors, that they give to advisors for advice, et cetera, et cetera. That feels pretty easy, but it gets complex really quickly when you have multiple share classes and liquidity and all sorts of stuff. So that was the original intent. 60,000 startups now use Carta to manage their equity. We manage the equity for at least half of the venture-backed startups in the US and 85% of unicorns. So an incredible data set to be working off of. The other side of the business is fund admin. So as we were helping founders with their equity backend, it became very clear that investors had similar and interesting problems. And because we already had so many founders on the platform, it made natural sense to say, well, we can really help the funds that are investing into those founders as well. So we run the back office for 3,000 US venture funds. That's portfolio monitoring, tax, valuations, all the bullshit that isn't investing into companies. We help venture funds manage that too. So we have data from both sides of the house on the funders and the founders.
Amazing, especially for people raising money for the first time, or shoot, even if you've raised money before, it's just such a thing you don't do that often. Maybe if you're lucky, and to have, I guess, just insights and a team like Carta to really understand the landscape better just puts you at such a better advantage. It's a dog eat whatever world, VC world sometimes.
Yeah. I want to ask the audience, has anybody in the audience, are you familiar with Peter's content on LinkedIn? Give me a yes or no. Anybody in the audience? No. Okay.
Yeah, I'm putting me on blast there, Adam. Okay.
Yeah. Well, no, we got. Yep.
Thank you, Curtis.
Peter's stuff is amazing because Carta has more data on startups and startup financing than anyone, and Peter's whole game is putting this data into visualizations and then writing posts that are like super insightful about it. And it's really, really awesome stuff. So we dropped his LinkedIn in there, and this data allows us to discuss some topics that are super near and dear to my heart that I write about a lot. The bootstrapping versus VC debate, and all sorts of different stuff with regards to funding and what happens to companies after they take funding. So that's why I am currently skipping a party to be here, and I'm very excited about this show.
We're glad you're skipping. Are you going to get to show up late?
Oh yeah, I mean it's going to go till like 3 a.m, and it's 8 p.m. now. I'm just like missing dinner right now, basically. I mean, apparently
you're just using this as a way to pace yourself, which I appreciate.
Yeah, and honestly, I've eaten so much the last 4 days that I don't need to go to dinner. I'm like feeling so fucking bloated. It's crazy.
Well, let's dive into it. So,
Can you do that first question I said? Can we do that first question I said, Pete? So, and by the way, this is the audience also. Like, people always tell me when I say you should bootstrap, it's like, well, I literally have no money. And when I say you should bootstrap, I'm not necessarily saying you should build a startup without any capital at all. I'm just saying, the smart path, in my opinion, that gives the founder the most optionality is to avoid taking institutional capital until you really want to or have to for some reason, right? Yeah. So I want to turn it over to Peter. Like, what are some ways that you have seen some of these startups be able to successfully do this? Like, founder has no money, but you don't go immediately to like Sequoia or something.
100%. And I actually think it's I completely agree with you, Adam. This is something where the siren song of institutional capital, especially venture, because it's so good at talking about itself, is very strong. But you can find yourself on the rocks really, really quickly there. There are kind of 3 sources of other capital that you might consider. So the first is just the core angel market. Friends, family, interested parties. These people do not have actual venture funds, but they're interested in keeping a close tab on what's exciting and new in technology, and they are probably interested in writing some small checks into businesses. The advantage of angels is they move quickly. They probably make decisions on a much more, let's say, vibesy basis. They like you. They like the idea. It's less about how much revenue do you have this week, et cetera. The disadvantage is unless you're in some of the core markets, they're definitely less connected. And so they don't always ladder up to more funding if you absolutely need it. The second form of funding that far more businesses should apply for is just grants of all different shapes and sizes. So this is deep tech, as of course, if you're in sciences or whatever, but it also applies to some other things. When I went out of college, I joined a media analytics company that had been granted a National Science Foundation grant, and that's where the initial funding for that company came from. So you'd be surprised at how many different kinds of businesses can qualify for some grant funding from either nonprofits or the government. So I definitely look into that. And then the third sort of is of course the best possible kind of funding, which is revenue. Revenue is the greatest funding in the world. Everyone should want revenue up front. And I think in today's age, given the ubiquity of AI tooling and how fast you can build product, like you really should be, if you're building a software company, trying to get to product as quickly as possible, because from that product you can iterate and hopefully somebody starts paying you for that. That might obviously not cover the bills and what the actual startup costs take, but it can take a chunk out of it.
So
love that.
I am curious. From there, I know you've posted a lot about this. We had shared a bunch of slides you had put together and sort of just like the state of the world of funding for B2B software type of companies. It showed that AI ate like 44% of invested capital last year. In software, that was about 61%. So I'm wondering, is this like actually like a healthy market evolution, or is there this sort of almost like AI tax, right? Where like non-AI founders are almost, I don't want to say locked out of the venture ecosystem, but maybe have a weaker hand than they did compared to somebody whose address is .ai.
Yeah, no, I would go stronger than that. They're definitely being locked out of the venture ecosystem. If you are building a software company today and you don't use AI to build it and your product doesn't incorporate AI, you will have an incredible difficult time raising from VCs. And to be honest, in this case, I'm not saying I agree with them fully. I think there's some edge cases where it doesn't make sense, but in general, if this is a tool that allows you to build product 10x faster than you used to, then I think the VCs are pretty reasonable in saying, why aren't you using it? Maybe you have a great reason, but it better be a great reason. It can't just be because I don't like AI. That's a great way. If you want to build your own business, go ahead, Godspeed. But if you want to take institutional capital, I know very few VCs in the last year here in San Francisco who've heard pitches for software companies that don't have AI included.
Now, I'm curious. So there's almost a little bit of a paradox here, right? So like, I understand where, number one, I think in a lot of software solutions, there's probably some benefit to AI or having some sort of AI feature, assistant, whatever it might be in there.
Yep.
As you said, not for everything. I think I would assume that maybe forcing an AI use case into a product that doesn't necessarily need it might be just sort of like trend jacking the current climate.
Yeah.
But I am curious that if you're building using AI, I mean, we were just talking about Claude as a coding assistant before we hopped on here.
Yeah.
I would also think that this allows more people, at least in the beginning, to bootstrap their way to maybe a larger, place, or at least validate their idea quicker or for cheaper. And then on the other side of that, of course, the VCs want someone who's efficient using the most recent tools. So do you feel that the folks who are AI forward are also able now to come to the table with a venture firm at a position that is a little further down the road than they used to before? And has it caused more hesitation or almost more competition with the VCs to like almost convince them to raise money?
Yeah. It's I would say there's a barbell in the market to that, where there's a group of founders for whom venture is basically all they're thinking about, and you don't really have to convince them that venture is the path they want to take. What you do have to convince is the VCs that this is the business to bet on. And as an example, when we used to talk about pre-seed funding, maybe 4 or 5 years ago, I'd wager that at least half, if not more, of those pre-seed companies didn't have any revenue when they were funded by VCs. So it was really like early stage wildcat betting. We're interested in this founder, we're interested in this idea, etc. These days, like at least half, probably well more than half of pre-seed rounds have some revenue if they're software companies. So like the pace has moved much more quickly. You made an interesting point though earlier, which was what's the difference between an AI startup that uses AI to build a product versus features AI in that product? Depends on who you ask amongst the VCs what they care about. Most people will expect you to use AI to build the product because, why are you not using JavaScript? Why are you not using React? It's just another technology that you should be taking advantage of. In terms of the incorporation into it, I'm not saying that every product needs to have AI chat functionality in order to qualify or something like that. I think the big distinction that VCs are tending to make these days is between application layer AI and infrastructure, meaning basically it boils down to, are you using someone else's models or are you building your own model? And the people that are building their own model, they're getting money in a way that it's basically unprecedented how much money you can raise if you are trying to compete with OpenAI and Anthropic. Whereas if you're building an application layer company, the competition is a lot fiercer.
Do you have any like concrete examples of that? Like how much money have some people who are trying to compete with OpenAI and Anthropic raised? Like, I
mean, Mira Murati's the obvious example there. She used to be the CTO of OpenAI, spun out and is now running Thinking Machines. Thinking Machines raised a $2 billion seed round at a $10 billion valuation. That was their first institutional capital, was $2 billion. So that's the.
Did she take secondary on that?
I have no idea, but I'm shocked if she didn't. Like, she should. if you're raising $2 billion, you should take.
Yeah, I mean,
You should definitely
it's such
take
an
secondary.
interesting idea, right? Like
Yeah.
seed secondary.
Yeah, it is literally just an idea. Like she was funded without a product. So
That's bananas.
it's a lot. A question in the chat from what is secondary? Secondary means selling shares of a pre-IPO private company. So this would, in this case, that would be Mira selling a bit of her own company and actually cashing, banking that cash.
In her own pocket. So
instead of
the money
raising for
goes
the
money goes to her instead of the company's bank account.
Yeah. So she didn't. That whole $2 billion wasn't secondary. Just like a very small slice of it would have been. But I'd be shocked if there wasn't a little bit at least.
Yeah. Can I ask, like, I talked about this scenario in the very beginning where, like, this has happened to me. It will happen to a lot of people on this call at some point. Like, and here's kind of like the journey, right? So like, sit there and you bang your head against the wall for years, and you're kind of just like, you don't have any traction whatsoever, and then all of a sudden you get this S curve.
Yeah, and
the numbers are always changing with revenue about what is interesting to the outside world, to investors and everything else. But like, let's say, and this is happening all the time, you were basically stuck, and then 18 months later, you're like close to 10 million ARR, and you're lucky enough to have not raised any money. Because I think more and more people are, you were saying that like pre-seed has revenue now, right? I think that's the goal for a lot of people these days. So this question's like two parts. Like, number one, you get this traction, people start banging your doors down. You're kind of like the first to market in what you're doing. And the question is like, I don't need to raise money, but like, should I? Should I like take $20 million from Andreessen Horowitz or not? And under what scenarios should I actually do that? So that's part one. I'll ask you part two when we're done talking through part one.
Okay, so caveat, obviously, if you are in a position that a 16Z is breaking down your door, or Sequoia, and they're trying to give you 20 million bucks, you're in a pretty privileged position. That doesn't happen to most folks, so congrats. On the broader question, I think it is very true that, as you mentioned beforehand, Adam, you can feel like you've hit an S curve and you're just like on a rocket ship, and that excitement and that enthusiasm, that momentum feels so good. And you're just like, your dreams become unbounded. You're like, I was thinking I could build a pretty good business out of this, but I was thinking way too small. This could be Salesforce. This could be OpenAI, whatever. And there is a potential that you get ahead of your skis there, and that what you've hit is like a local upswing, and that local upswing has no repeatability or whatever. And then if you take a lot of institutional capital, you'll be very sad, because if you scratch a venture capitalist, underneath you will find a big sign that says grow faster. That is what they want. Growth is the core of all venture capital. Whether or not, sometimes you build hardware businesses and it takes a while, but in the end, growth is what they want. So should you take that money from Andreessen? 80% of the time, if you were never planning on fundraising, I think you should stick to your core plan. And then maybe 20 or 30% of the time, you should take the money and not spend any of it if you can avoid it. Because once you're just committing to a totally different capital stack, and that means that your exit has to be huge. You have eliminated small exits from a good path. Exiting for $100 million if you took 20 million in funding is not awesome.
Yeah.
And definitely the VCs won't care about it, right? You're looking for $1 billion at that point, and then you got to get big, and you got to get big real fast.
Yeah.
Before we get on to, sorry.
Go ahead.
I was going to say, before we get on the point two, I'm just curious, while we're in the neighborhood, how upfront I've never raised money. How upfront are these, venture firms about what basically that redefinition of success? Like, hey, this isn't going to be a success.
Super, super upfront. Actually, that I would push that back. If you don't understand it as a founder, like, you get out of this game. Like, you should be able to read these funds' websites and understand what they need. And you can work backwards from the math, right? You are one of 20 to 25 portfolio companies that will invest in out of the fund. How big is the fund? How big is the check they're giving you? You need to return the fund in order to be useful. So if you get a $5 million check and it's a $100 million fund, you need to return $100 million to them after everything is netted out. So that's $100 million. You don't sell for $100 million. You return $100 million on their $5 million investment. That's what they want. Like, you should know that going in. This applies a little bit less to the very small funds, but if you are ever talking to Sequoia, Andreessen, et cetera, if you are not a unicorn, you are not useful to them.
Yeah,
for sure.
That is wild. So I have thought, so by the way, the reason I'm like so vividly describing the situations because it actually happened to me.
Yeah.
I was just like fully convinced I had a unicorn on my hand, and like lo and behold, 18 months later, we had a ton of competitors. Instead of experiencing revenue expansion, we were getting undercut and feeling contraction, and a bunch of copycats, all that stuff. And it was just brutal. And I'm so glad that a year and a half earlier, I probably, because like your ego, you're so tied to this, company and its success, and like people are around you pointing at these other unicorns, right? This is 2020 or 2021. Like a lot of the unicorn stuff then is not what it is now. So there's managing that part of it too, which is strange. Is there like, are there retention metrics that would make you feel better about raising? Like, is it sort of like?
Yeah, I think that you definitely would predicate some of your decision to fundraise. And again, some people have gone for the VC capital from the beginning. This was always the plan. And so therefore, they would be fundraising. They wouldn't really think that hard about it. They'd go, this was my plan. I think I can put this capital to good use. I understand the path that I'm on. But if you're the bootstrapper who is getting attracted to VC because suddenly your business takes an upswing, retention is absolutely hypercritical. Like your NDR, your NRR needs to be very, very, very good. In that you are attracting new customers and your current customers are spending more with you, and that your churn is very low. And the other point is the one about the market. How big a market is this? It's not an easy question to understand. If you had looked at Uber in the beginning, you would have said the market for Uber is the market for taxis, and that's not that exciting. Now it's blown off of that, right?
Yeah.
So judging whatever the ultimate TAM of your market is always a very hand wavy, there's math, but the math is mostly like fiction written in Excel. Understanding where you sit in that market and your adjacencies, like what other products can you build to help that same ICP? How are you envisioning growth over time? That's really important. You're not going to have all that upfront, but if you're sitting there going, I think I can build $100 million business out of this, but that's about it, and I don't see an expansion beyond that, taking capital is a risky choice.
Yeah. And then I'm going to parlay this into part 2 of this question. I love this post that you wrote about, the post was about speed to Series A, but it had some other interesting, or maybe it was another post. Like, so number one, it seems like out of like the 2020 and 2021 cohort, about 50% of companies aren't even going to make it to Series A. Is that about right? So like, think about that. Like half of companies
from seed. So I know a lot of them didn't even make it to seed. So yeah, it's hard.
Yeah.
It's hard.
Yeah. Which is wild. I mean, that's just like, if that doesn't tell you something about the game you're playing, then I don't know what will. And then another part of that post was like, investors want you to raise ASAP so that they can mark their portfolio up, which they get graded on for raising their next fund, right? So like the question I have for you is like, that's actually a weird incentive that I had not heard of until that post. What are some of the other weird incentives that founders don't know about that they should, just to know? Like whether you're contemplating the VC route or not, it's like, what are some of the weird incentives from running a portfolio that differ from running the company?
So many, so many. Let's list out a couple ones. One, so how does a VC fund look great? So how does a VC fund make money, and how does a VC fund raise their next fund are oftentimes two separate things. So a VC fund is a 10-year life cycle, maybe 12 years this time. It's a long fund. You invest for 4 or 5 years, you wait for another 4 or 5 years, then those companies IPO or get acquired. It's a long, long bet. You don't raise one fund every 10 years. You raise a fund every 3 years, 3 to 4. So in the interim, how do you look good to your LPs, the people who gave you money? Well, you look good if somebody comes along and marks your companies up. So if you're a seed stage investor, what you want is Sequoia to come and do the Series A at your companies because it looks like you're a genius, you got in early. That's what you want.
Yeah.
So the faster that happens, the higher the markups are and the better your fund performance metrics look in the interim period. But if you get marked up by Sequoia, that's not a guarantee you're going to exit for money. That company still might be worth nothing. We don't know. Series A is still very early on. So like that's one incentive, the difference between a markup and terminal value. Second incentive, if they have a big portfolio and you're not doing well, they're not going to spend very much time with you. VC is a power law industry, meaning 1 or 2 of their fund portfolio bets are going to be the ones that make them all the money. So if you're just kind of struggling along, most VCs, even if they're good people, most VCs are just naturally not going to spend that much time with those companies. You're going to find it harder to get a hold of them. They're not going to be as interested in the board meetings. They're just kind of checked out because they've written you off because you're not a big part of their fund portfolio model. That happens all the time. Third incentive misalignment. They may push for you to take an acquisition offer that you don't want. Because they're like, look, I don't think you're going to be a big winner, so just getting a little bit of money in my portfolio would be nice right now. Just take that offer. And you're like, no, I think we got something here. Et cetera. Or the opposite. You might think, ooh, I just got a cool offer for an acquisition. How exciting. And the VC goes, no, I don't think that doesn't do much for my fund. I want you to keep going. I think you can get way bigger. So like exit misalignment. It happens all the time. The last point that I'll make is, and this one, there's a lot of stories out there about VCs replacing CEOs when they, before they IPO or like as they're getting tricky. And some very, very famous ones, Uber as an example, Travis got replaced before they IPO'd. That happens. What's more likely is that the VCs and the investors are just like causing a lot of management kludge at the executive level. And they're just like, Vinod Khosla has this idea where he says that 70% of VCs are net negative and 25% are neutral and 5% are really helpful to the company beyond the capital that they raise. So like, there's just a lot of kludge, and I love a ton. I know so many VCs who are incredible people, incredible investors, and are so focused on helping companies, but there are structural misalignments here occasionally.
That's super insightful. Okay. I want to move to this topic that we were talking about over our DMs. Kludge, I think it's just friction, right? Like that's what.
Friction. Great.
Bureaucratic. So another way of thinking about
in the gears.
Another way of thinking about this kludge topic is like, even though they may not have control, they can do a lot to influence you, slow you down. It's just, they are a seat at the table, especially the board seat.
10-year marriage. 10-year marriage. Like it is, you are getting married to your investors. And it's tough. It's way harder to divorce them than to divorce a partner in the real world.
It's a very serious thing. And like, that's why it's like, it's so strange that it so often starts with just like a lot of excitement and then like taking the highest price.
I think it's the reason why. So out in the world, venture is a tiny part of business creation. 99% of all companies ever created will never take venture capital. They probably won't even look at it, right? The reason why venture is so seemingly default in tech entrepreneurship is a little bit of path dependency. Like the history of tech is littered with venture in a way that other ecosystems are not. And two, the way that zero marginal cost works, having a lot of capital up front and then spreading it over a huge growth path towards IPO makes a lot of sense for software businesses and other deep tech businesses. So like the model fits tech in a way that it doesn't other places. What's a problem is that bootstrapping, outside of Adam and some other folks, doesn't have any marketing for it. Whereas venture is amazing at talking about itself. and there's all these regular checkpoints. You raised a seed, you raised a Series A. Companies see you get that profile in the Wall Street Journal. We're a big hot Series B AI company. Like there's just a lot of milestones that external people can track. Whereas if you're a bootstrapper, we're just running our business. I'm like, what, like we reported a profit this year. Like nobody cares, right?
Nobody.
Yeah, nobody cares. So you can either choose the side of really high expectations, a lot more attention, but potentially less terminal value, or I'm going to build in the dark and no one's going to care about my business and I might exit for more money. It's sort of your choice. But there's also downsides to the bootstrapping. I mean, attracting a great engineer is easier if you have Sequoia on your cap table. That engineer's like, this is a real company. I can leave my job at Google for this. Like there are advantages to having brand and credibility from venture funds.
So what are other advantages besides that, by the way, before I ask you this next question?
Capital.
Just to keep it balanced here.
Capital, first and foremost, is the advantage. If you are in a crowded space and you think that there's a big pot of gold out there, but it's only going to be available to one or two people, if you have a lot more money, you ostensibly can build a lot faster. So that is a thesis. Second, there's brand and credibility, not just with potential engineers, so on the hiring side, but also with customers. You know who has an amazing Rolodex of a lot of businesses that you might want to sell to? Andreessen Horowitz.
Yeah.
If you get a partner from Andreessen on the phone with, I don't know, like Costco or something, and you're selling into retail tech on that side, like that's very helpful. And then the third, the way that Andreessen himself likes to put it, this is only applicable to the biggest funds, but it's like he honestly just came out right on, baldly and said power. Like, he in particular and some other people in the VC ecosystem are in the right rooms. They are pulling levers on regulatory processes. You are interacting at a level, if you take megafund checks, that other companies would dream of having as levers for their business.
Yeah, that's a really interesting point. Great question from Kirill. This topic of seed strapping. So
yeah,
how real of so first of all, how pissed off will VCs be if you actually do that? Because it's sort of like it takes away that one thing that they're graded by. If you're just like, so I've heard a lot of people tell me that that's what they want to do. We're going to like do this and then not raise any more money. Like, is this idea of seed strapping overblown versus the reality that it actually happens? And the second question is like, do investors even allow it, or will through subtle pressure, will they just make you not do it?
Look, if you're planning on seed strapping, and that's you've got that vision out of the gate, I would probably be honest about that with VCs. Now, that means that some of them will back out. No doubt. Because of this idea of the interim marks period, right? If you seed strap, there is no Series A, and therefore there is no valuation change, and therefore they can't show progress to their LPs. Now they can show your revenues and stuff, but it's not the same. It just isn't. So there will be VCs who don't do seed strapping. There are some, like Bryce Roberts at Indie VC and others, who love it, and it's their whole business model. I think his tagline is the last capital you'll ever need, which I love. So there are people there that have bought in, and you know what they did? They pitched their LPs on this model. Yeah. They're not misaligned with their own investors. They raised money to do this thing. So therefore, of course, they want seed strapping. It was a very thoughtful approach from their end. Yeah. The other thing, though, and this is, we're bad-mouthing VCs a little bit. On the founder side, what's hard is when you take seed money and you're doing well, and a Series A fund comes and knocks, that's hard to say no to. So it's not just VCs who are interested in the next round.
Yeah, I know lots of founders who have, like a handful of my friends have literally spoken to me as though their net worth was, their percentage of the value that they raised at.
Yeah.
Only to have those companies be worth zero. You know,
Yep.
like there's a major kind of like delusion that occurs
Yeah.
that is really hard to resist, quite frankly.
Your valuation is not your self-worth. Please repeat after
Yeah.
me. Like just like tattoo it on your forehead. Like this
Yeah.
is not real money yet. And also like you're a real person. You don't need to be defined by what your valuation of your company is, etc. So that's hard. That's super easy to say, but hard to emotionally disaggregate.
I remember that. I'm sure you watched Silicon Valley, the
Course.
show. Okay, so there's the scene where Richard's at the bar with a guy, and he's like, "Well, you could have just taken less money," because the guy's like, all he's
Yep.
having down rounds now. He's like, "Wait, what do you mean take less money?" He's like, "Well, you just didn't have to take like $1 billion." He's like, "It's true. Then maybe we would have had easier targets, and then we wouldn't have had these down rounds." And that like he starts going through the process of what that would have been like.
Yeah.
And I always find that interesting, and I think I've always been very interested with sort of like cognitive biases, and I think there's one that seems to occur pretty frequently with entrepreneurs. I'll get into that in a second. I have a simple phrase I say often. I say that founders are ambitious people, and ambitious people tend to get ahead of themselves. And I think that happens all the time. So there's this cognitive bias called the endowment effect. For those who are unfamiliar, I'll kind of give a brief definition. So I have it pulled up here. It's a cognitive bias where individuals value an owned item higher than its objective market value, often demanding more to sell it than they would pay to acquire it. This is driven by loss aversion, which is the pain of losing, where the pain of losing is greater than the pleasure of gaining, and emotional attachment. And this effect causes consumers to overvalue possessions, complicating transactions. Where I think that comes into play here is, I mean, if you are an entrepreneur and you're building something, the amount of time, energy, effort, money that you're pouring, you are pouring like your whole heart into this. Like, unfortunately, a lot of people are pouring more into their businesses than they are into their relationships, their family, especially in those early days when it's so grindy. So I guess just curious when it comes to the difference between these conversations with the larger firms, like how many is it common where almost this endowment effect gets amplified by these conversations of these larger VCs, and they're almost steering them towards an outcome or a path that they might not genuinely want, or maybe that just isn't best for them as an individual?
Look, venture has killed a lot of businesses because it wanted them to scale to a place that didn't make natural sense. That is a fact. Now, it's also helped a lot of businesses that to realize ambition that perhaps they didn't understand at the beginning, and those businesses are now household names. Both of those things are true. It's just that in a power law world, where one or two out of hundreds of bets are going to make or break your company, you're looking for those outliers. Everything at the beginning kind of looks the same, right? It's a highly ambitious person. They have, as you mentioned, an endowment effect, or I would even go beyond that and say just a crazy innate optimism that like we are going to change something fundamental about the world. Like you don't become a entrepreneur unless you are optimistic that the world can change for the better. And if you have someone who's pushing you on and saying, "We totally agree. Here's a bunch of money to to go make that change real," it's very difficult. It's totally rational to get caught up into that, right? It's perhaps not rational, but incredibly understandable to do it. And then there's the question of, okay, so maybe let's say you got what Adam said and you had that great year, right? Your revenue just went up, you crushed it this year, and now you have 3 or 4 different funds who are interested in you, and you get term sheets from all 4 of them. Should you take the highest valuation? That's the big question. What I think that most entrepreneurs don't understand about valuations is they are not some innate reflection of your company at the early stage. You're not really a $50 million company. As one person paid that for some equity, what you are is a company that a person who had money was willing to bet would be much bigger than $50 million. And so again, internalizing that high valuation as though like this is me can be very corrosive. And sometimes taking the lower valuation means the next round is easier and all those things. So it's taking the highest valuation is, again, easy to say to avoid, but really difficult in the moment to come away from.
100%.
And I think there's this thing that also happens where like I know a few young founders that have raised at around 50 or like maybe 75, and their businesses have not really gone that well, and they're like burning dough, single digit ARR, let's call it like 25% growth rate annually, right?
Yeah.
And I truly believe, because they have told me, but it seems crazy to me, that like they think that they can sell their business for like 50 or 75 million dollars. And I'm like, God, every time I'm like, okay, like I don't know who's telling you this, but like I haven't seen any businesses sell for 50 or 75 million dollars,
Yep.
let alone something that's burning money, not growing 100% a year, and whatever. So I think there's, if you are a founder and you're in that position, it's almost like that's like, I interpret it as like they're like saying it as though it's some sort of a way out. It's like, well, my situation kind of sucks right now, but like
Yeah.
worst case scenario, I can punt this thing for 50
Yeah.
million. So like whatever. But like I think it would really help them to know that that's not actually an option. And it's like,
Yeah.
where like, it's like, is there data around those low price, like the actual frequency of low price sales that occur? Do you have that data?
I do. And to double down on, perhaps we do another bias or heuristic here, like sunk cost fallacy for a lot of those founders of saying, we're just gonna plow some more money, some more time, some more effort. Adam, you said, I think something really insightful earlier. You might only get 2 shots.
Yeah.
3, if you're really lucky, like 3 businesses in your life is an amazing record. Many founders only get 1 business. So it can feel so there's so much pressure to make this one work. Right. And so then you're convincing yourself about potential exit paths. You're talking candidly crazy about the like, if you think private equity is interested in your business, if you're burning cash and growing 20% a year, good luck.
Right.
No chance. Especially right now. Did you see what happened to public SaaS stocks over the last 3 months?
Slaughtered.
Slaughter. Like if
20%
Salesforce is
across the
getting
board.
wrecked
Yeah.
and they're making billions a quarter, your money burning young startup that is not growing that fast has no chance.
Yeah.
You will not get bought. You might get fire sailed as an acqui-hire so they can have you, like you're basically just getting a job offer from that company. That's what you're going to walk away from. Like it is getting acquired at that scale is very, very difficult. The 2 places where you can get acquired is if you raised no money and you're profitable,
Yeah.
right? That's easier. And 2, if you're growing super quickly. But then again, if you're growing super quickly, why are you looking to sell?
Right.
You're back to the catch 22. So how often does this happen? To put it broadly, if you are in seed and series A, something like 2 to 3% of series A and seed companies get purchased every year, get acquired. 2%. Maybe a little bit less if you're just running this annually.
Yeah.
That's not much. That's not many of them.
No.
And many of them are getting acquired because they are at that scale. It's oftentimes we're really interested in this team.
Yeah.
And we'd like to overpay to hire these specific people.
Yeah. Okay, this like is a great this is a great transition into this other topic I really want to go into. It's the YC topic. And like so the YC one is really interesting I think there's a few interesting things about it. Number one, I think I read that Sam, on one of Sam's blog posts, he said, if you have a 1% chance of being a billionaire, you should do that.
Mm-hmm.
Yep. And from a probably, and by the way, he did that, and he is one. So it's like, it's quite easy
Good
to see
example.
what's worked for you, and
Sure.
like you're friends with all the other guys that it worked for.
100%.
But I'm so like this thing just sits with me. It's like, if you are good enough to create a unicorn, and you have a 1% chance at that, like you probably have like an 80% chance of creating something that spits several $1,000,000, into your own pocket every year. And,
Yep.
if you're open to this idea of like running it forever. And, similarly to bootstrapping having shitty marketing. Like I don't think I've ever heard anyone like everyone always asks me what my exit is.
Yeah.
And I'm just like, I'm having a great time.
Right.
You know,
Yeah.
like I'm just trying to do this for as long as humanly possible. You
Totally.
know, like I just moved my family to Aspen. I'm skiing 5 days a week. Like this is just like the most amazing thing that's ever happened to me, this business. I don't want to sell it, you know? So there's the aspect that there's a few things about exits that are just really interesting to me. It's like, and that are related to funding. Like number one, you take this institutional capital, there's a chance that you'll take meaningful secondary out, a chance, I think.
Sure.
And
Yep.
but like all value that accrues to you is basically transaction dependent.
Yep.
And that, you know, and so like you need to like be able to run your company in this burn environment, which I think is a lot more stressful than running a profitable company, but you are also subject to the capital markets
Yep.
and whatever's happening in the M&A market. And I think people overestimate the frequency and the likelihood of this stuff happening. As an example, you know, are these founders that I'm telling you about who are like, oh yeah, I'll just like punt this thing for $50 million. Like, no problem. It's like,
Who's buying?
okay, to who? Yeah.
Yeah. Right. Why
Can
are they
you
excited
please
about buying?
introduce me to them, please?
Amazing. Yeah. You
Yeah.
found some suckers. Like, that's great. Yeah.
Yeah. So I was just wondering, like, you know, you know, first of all, do you think that I'm off base, that like, you know, for most founders, it's like that if you have a 1% chance of being a billionaire, you should do it. It's like,
Yeah.
I just like then you have a 99% of failing.
Yeah.
You know, like how would you think about that?
I think there's a couple mental models that you can use. On the YC side, well, let's put it this way. YC takes, and again, if you are accepted into YC, you got through a really, really, really crowded application process. Now, most of those companies do not have businesses, really. They're like
Yeah.
maybe a product, maybe. Like it's a very, very early stage thing. And they're going to take 7 to 9% of your company off the top. And they're gonna brand you. You're gonna learn a lot in the YC course, of course. It's a great, great program. But what they're giving you really is the brand. They're saying, I am a YC founder. And Bookface, which is their internal network, which is an amazing network. Like startups selling to other YC startups is basically the first 5 million in revenue for every YC business. It's crazy how it's an,
Yeah.
I mean, kudos to them. It's an incredible go-to-market effect there. So that's what they're giving you. Is it worth it? I don't know. Like you said, if there's a 1% chance that this company's going to be worth $1 billion, maybe it totally is. But that gets into a bigger question, which is, why am I building this at all? Right? Like the culture of Silicon Valley, as exemplified by YC and some of the mega funds, is a culture of radically increasing people's ambition. And sometimes, and we laud the outliers where it works. We don't really talk about how many bodies are in the wake there. And there are a lot of dead companies that could have been, as you said, wonderful cash producing $6-7 million ARR businesses that needed to be massive. And they did things in order to grow fast that didn't make sense. And therefore their equilibrium came back to zero. That happens all the time. So when I'm talking to founders, I don't think that YC is good or bad. I think YC is actually great for venture. I'm glad that model works for them. But it comes back to you. Like, is that the ambition? Put it this way. If in 10 years you make a low single digit millions of dollars running a profitable business and you have a great life, are you happy? Or are you going to be going, I could have been Sam Altman, right? I could have changed the landscape of things.
Yeah.
I'm not saying one is better than the other. Just like what is going to make you internally satisfied.
Yeah. Yeah. And I have met people who, you know, I know this guy in Austin who's like a 5-time founder. His name's Brett Hurt. He took this company, Bizarre Voice, from like launch to IPO as the CEO. And he's like, man, I really respect what you're doing with this bootstrapping thing. I just can't do it. He's like,
Yeah.
if you gave me an ice cream stand, I would try to make it global, like the biggest ice cream.
Right.
You know, he's just like, I'm just like
Yep.
wired to try to press this like to the absolute max. You know, and he's good enough to do it.
Right.
Just the other, right. And you know, another one of my buddies always says, you know, don't take VC unless you know you have a unicorn, which I think is the hard part because people get the term wrong a lot.
And like, who really knows? Like,
yeah, exactly. And you know that you would be unhappy if with a smaller company, if that were the best path for the company.
yes.
Right. Like, I would be unhappy making $10 million a year.
Yeah.
Because this thing's not a unicorn.
And the other point in that is everyone else that you're founding with going to be unhappy? Like, solo is great. Solo is amazing. I think there should be far more solo founders. If you're building a VC-backed business, often you have a co-founder, and then you are in the happiness conversation applies to two different people, and who might seem aligned right now, but 3, 4, 5 years down the road, like your paths may diverge. Like it's a tricky thing to align up on ambition in that way.
Yeah. And I just want to ask the audience who's still around, is anybody, you know, who are the bootstrappers? Who's taken institutional capital? Can we get a response from the crowd? Bootstrap. You see who my audience is, right?
Yeah, I don't know. I feel like the heuristic is kind of hard here, Adam.
Yeah. Yeah, it's a self-selecting.
Yeah, exactly.
Self-selecting audience. They come for what I talk about, I guess.
Yeah.
Dude, Peter, this was so awesome. How can people get in touch with you?
Yeah, I mean, I'm doing data graphics and all sorts of insights on LinkedIn basically like 5 times a week now. So you can find me on LinkedIn for sure. But if you're ever interested in reading about like what is going on in venture generally, we publish a ton of massive research on this, and it's all at carta.com/data.
Carta.com/data. Cool.
That's it.
Well, thanks for being you're just such a great voice for this topic, Peter. You're a realist, which like you're selling the reality, not the dream. And I think that is so important. You're just, you know, telling stories with data as your LinkedIn profile suggests. You're really living up to that. And just thank you for coming on and having the real conversation with everybody. I think everyone found, I've already seen some comments, best episode yet, all the stuff. So we thank you a ton.
No, appreciate you guys. I work and live amongst VCs and founders basically 24/7. And I do think that even in this little bubble, a breath of bootstrapping, fresh air, or just like the conception that there are different ways to build a business and every one of them is good and every one of them is bad is useful. Like no need to put something on a pedestal where it's really just a business model.
I love it. Well, thank you so much for joining. This was an awesome episode. Folks, the recording will be live later this week. I'm going to drop in the YouTube playlist or the YouTube channel. There is a new channel for Unfuck My Startup as of earlier this year. Yeah, keep those on. And go ahead, subscribe, whatever it is you do. And then as of, last week, we started dropping some shorts. So keep an eye out for those.
Yeah. Next week's guest is the one and only Pete Crowley.
Whoa.
Yeah. It's so meta. The host is the guest.
How the turntables. Yeah.
Yeah, exactly. What are we going to be talking about, Pete?
Yeah. So next week, I'm officially doing the hard launch of my consultancy market work. I soft launched it back in July. RB2B is a client of mine. I help run the show. As you all know, we're going to be talking positioning, experimentation, and where most founders and marketers waste time, money, and effort in their go-to-market motion. And let me tell you, it's like 80% of what they do is waste stuff.
Shut up, Pete.
Sorry.
I said, shut up, Pete. Don't talk about us marketers that way.
Well, we'll talk about running cheap experiments, how to prioritize things and just all things go to market, positioning. It'll be a good episode. I'm excited to show you guys what I've been working on and can't wait.
Awesome. Peter,
thanks. Pete.
Thank you,
See
Peter.
you next week.
Enjoy the party, Adam.
Bye.
Take care, everyone.